Investors Chronicle.
Hello, one and all. It's the Companies and Markets Show, recording this week on Thursday, the 11th of July. Today, we are going to be talking property. The new Labour government has sprung into some form of action with a handful of proposals aimed at boosting housing supply. And there's plenty of activity going on at a company level too, from a Barratt Developments trading update to Bellway's improved offer for Crest Nicholson. Alex Newman is here to give his thoughts on these businesses and on whether planning reforms will have the desired effect for house builders and, dare I say it, for the country as a whole. After that, we will move on to a different type of real estate, the salubrious world of student accommodation. Unite Group had its own trading update this week, set against a backdrop of uncertainty over the state of the erstwhile boom in overseas student numbers. Julian Hoffman will examine whether cracks are appearing in the foundation of this thesis. Meanwhile, the IC cover story this week is our annual Top 50 ETFs feature. So Dave Baxter is here to share with us some of the changes to the list this year and take us behind the scenes of our expert panels, debates and disagreements in some cases. That's later on, but we'll kick off with property. Plans to encourage more house building were at the centre of Labour's election manifesto. There's also an improving economic backdrop to factor in. And yet, it struck me at least, Alex, that the situation on the ground is such that Barratt Developments update this week was relatively downbeat.
Yeah, so full year trading update for the year to June, ahead of fuller results that they'll be putting out, I think, in September. I mean, it wasn't a great year for Barratt. So I think they had something like a nearly £200 million charge, lower profits, lower completions. The other fly in the ointment, I suppose, for investors looking forward, not just backwards to what has been a quite tricky couple of years for the house builders and Barratt, maybe chief among them, is that they still expect completions and forward sales to fall a little bit. So, you know, the drop's not nearly as much as the past year, but home builds expected to dip about 6% in the current year, so to June 2025. So I suppose with an uptick in sentiment on the back of the election and you know the promises that Rachel Reeves and the Labour government, which we can discuss in a bit, I'm sure, are making. I think this was perhaps a reminder to investors that, you know, this is going to be quite a slow tanker to turn around, and for the big house builders at least, you know, recovery's probably not imminent.
Yeah, as you say, these things take time, as the nature of house building would suggest. We've got various strands to discuss here, as I mentioned, but so let's skip around a bit. Why don't we immediately leap on to M&A maybe, because there's been a bit of news there, as I said, as well. You've got the Crest Bellway deal. You've got the Redrow deal as well, which, you know, is going to have an impact on the sector, on these companies. Do we think these are classic downturn defensive moves? How do we think these two combined companies will look coming out of these mergers when they finally complete?
Yeah, and I suppose the other one we can add there, although it's not part of this mini wave of consolidation, is the Vistry Countryside deal, which is over a year old now, but I suppose still part of this kind of downturn, you know, sort of quite a low point in the cycle for the house builders. So yeah, within this mini wave of activity is clearly an element of defensive consolidation here. You know, there's obviously greater bargaining power at greater scale, cheaper access to cheaper capital, and sort of less replication. You can take some costs out by consolidating. I should say though that I suppose the greater bargaining power and cheaper access to capital are probably more long-term considerations rather than things that are going to have immediate effects on these tie-ups. But I mean, really, the history of this industry, like many others, really, is one of consolidation. I mean, there has, certainly since the end of Help to Buy, there hasn't really been much of a leader. Persimmon might be a notable underperformer, but I think within the listed sector, there's not been a standout leader here. You know, in some ways, there are differences between them. There's, Vistry, for example, will have a bit more focus on partnerships. Others will have sort of geographic focuses or different kind of focuses on different customer brands or grades of housing quality. That kind of means that because there's not a clear differentiation between some of these companies, wouldn't be wildly surprising if we did see more deals. And it also means that I suppose sticking these parts together is not quite as complicated as other kinds of M&A. So yeah, long-winded answer. Defensive kind of makes sense, sort of just happening always in the background with house builders anyway.
Let's skip on again now to the Labour proposals, because they have been making a big deal of them. They were, as I say, a centre point of the manifesto, and within a couple of days of getting to power, Rachel Reeves outlined a few things which were all in the manifesto, looking at building on the grey belt, if you want to call it, which is the part of the green belt which is not that green, industrial sites, things like that. Adding planning officers, albeit I think the number stated a few months ago was 300, which is about a tenth, apparently, of the number that have gone out the industry over the past 10 years. But also making reforms to the planning system, which should, in theory, make it easier to build by changing some of the, I think, default assumptions, and overall reintroducing mandatory house building targets, trying to get to this figure, this almost mythical figure that all governments like to try and target, it seems, of around 300,000 a year. They never quite get there. What do you make of the moves or the announcements so far? Is it going to be any different this time? I mean, we clearly know the issues in the country in terms of the affordability of housing, and that's clearly a big focus for Labour, trying to do something about that. It feels like a step in the right direction, but maybe more will be required. And will they be able to achieve it? There's all the issues about planning and local interests and things like that, and questions over whether the government will centralise a lot of this decision making to try and stop local opposition. I don't know, but what do you make of all the?
Well, I think as you kind of your question implied there is that there's a lot of uncertainties despite the tone at the moment, and we're having to unpick reality from promises at the moment, which is very, very tricky to do, and seeing how it all plays out. If you were cynical, you'd say, okay, another 300,000 homes a year target. We have been here before. I suppose the difference here is there seems a bit more combativeness potentially from the Labour government. So that I think Rachel Reeves is kind of keen to make the case for local authorities setting sort of these mandatory targets, and at the local level, we have seen this before, and we're seeing it in some of the responses this week, that councils will push back and say, we're best placed to identify local housing need rather than central diktat. But I mean, arguably one of the problems with the planning system has been precisely that: too much power locally at the local level, which sort of diffuses the ability to meet national demand. I mean, it's not easy to do it either way. It's not easy to do it anything in a centrally planned way. But if you were, and I suppose we've got to bring this back to the investment case rather than just making this a chat about housing policy. If you're trying to make the bull case for the house builders, I suppose you'd be encouraged by the new administration's I suppose I use the word combativeness. Maybe another way to look at it is they're not trying to build quite as much consensus as I think was the case under Michael Gove, which led to this sort of dilution, targets not even being close to being met. So yeah, I mean, at very top level, I think you'd probably say that these proposals have a bit more meat on the bone, because they are, they're trying to be a bit firmer. But we do have to point out some, major caveats here. I mean, Labour's obviously going to place more emphasis on greener, sustainable development, which there's a tug of war going on there with the developers. They would want to raise the quota on affordable housing. That's always a tug of war, we know, with developers. And then the other big picture here is demand and how it can be fulfilled, even if the underlying demand is there. The key things are, one, affordability. And so at the moment, we've got expectations for 1 or possibly 2 rate cuts this year. With interest rates and mortgage rates, 5-year mortgage rates still around 5.5%, 6%. It's gonna have to fall a bit further, I think, for it to really move the needle on that marginal demand coming back. We are a long way away from the years of help to buy, where just credit conditions were so good for house builders, regardless of government policy supporting everything on top. So yeah, there are other pieces to the puzzle. It's not just going to come down to setting a new target, getting a bit tougher with local authorities, and hey presto, we've got 1.5 million homes in the next 5 years. There are other bits needed for this to work.
To return to the house builder angle as you did there, from their perspective, I think some of the investor interest is in whether these planning reforms effectively enable the land banks that have been built up that become even larger because these companies are aware of the delays to planning approvals. So they effectively amass more and more land, whether that will free them up to start building themselves, as you would think would be a goal of the government, given the overall building targets, and they can use their strategic land banks, which is land on the verge of getting planning permission or on the verge of meeting requirements. If more of that land can start to filter through, then you can see the volume recovery, which is still a way off, as we saw from what you said about Barratt's trading update this week. And that clearly, once volumes start to rise, if they start to rise significantly, that should be supportive for the house builders. I suppose the question maybe is, what's the bear case, if there is one? Because we have also seen some noise about affordable housing targets. I think Labour has said they want to be more stringent on these. We could get quite deep, I suppose, into the question of land value and how that is captured. A lot of that goes to the landowner right now. Some people, including Vistry this week, were saying if you increase affordable housing targets and make house builders responsible for local infrastructure, things like that, then effectively that will reduce the value of the land, the amount they pay to the landowner. It should increase supply, maybe a bit of a virtuous circle. At the same time, you could then get a situation where you're getting house prices falling, which again wouldn't, well, for some people certainly wouldn't be a bad thing, but for the classic of a politician might be concerning. How would that play into the house builders, market case, I suppose? Whether effectively these planning reforms, whether the volume recovery will supersede the question of, if we do actually get a more radical housing policy and land values start to change, how those two things will weigh up. It's quite an impossible and also very long question, but I don't know if you have any thoughts on that kind of debate.
Yeah, I don't want to pass because but I suppose the other consideration you got to factor in there is, the part of the valuation of these house builders is the land bank itself, and a sort of radical reappraisal of. They're not going to develop those land banks overnight. Obviously, no. This is a slow game, but a radical reappraisal of those land banks also change the the valuation case, and these are assets that many argue that the house builders have hung on for far too long, and there's too much speculation when it comes to land in this country, but. They will also have to, replace the pipeline at some point. You can't just, you can't just wear those assets down with no sort of 10-year plan, I suppose. The other bear case, I suppose you'd make is on margins, and it remains to be seen how. We're not going to, like I said, we're not going to return to the years where conditions were just seemingly completely built for house builders, where they were able to earn very, very lucrative margins and just keep reinvesting into new land. What we've had over the last few years is demand and prices explode in the pandemic, and then we've got the explosion in mortgage and building costs. We touched on mortgage costs and what has to happen there. It looks like total build cost inflation, if Barratt's comments this past week are to be believed, are not only falling, but are maybe going to return to a slightly flat level over the coming year, which would be encouraging. But that doesn't mean that margins are necessarily where the house builders would want them to be, or have got used to being over the last 10 years. So, I suppose the degree to which the sector is going to say, well, look, we're just going to swallow the new reality. We're not going to wait for 20 plus returns on equity or higher when it comes to profit margins, and we're just going to plough on, and it's going to be a volume game. I think recent history seems to suggest they're a lot more cautious than that, and there is, they're always trying to, I don't want to say they sit on their hands, but things don't move quite nearly as fast as it sometimes feels like they could.
Mm. Well, it'll be interesting to see how this plays out, because it's certainly been the case in the past couple of years, at least share price wise. All the house builders have been very sensitive to interest rate changes, as you'd expect, and expectations of base rates being cut, which may well happen, and mortgage rates coming down. But now there's the national policy to factor in as well. So making for an interesting, if complicated, sector. We'll keep an eye on it. You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. We're going to turn, though, to another part of the real estate world now, though. Student property. Julian, you have been looking at this sector or subsector this week through the prism, first of all, of a trading update from Unite, which obviously is a big student accommodation provider, FTSE 100 listed.
Yes, not the public sector union.
Indeed.
Yes, Unite came out with a trading update this week. It's a typically solid company. They've enjoyed a boom really in student accommodation for going on 15 years now. It's been quite a lucrative area for this particular kind of REIT. And this year so far seems to be no exception to that rule. Their rental growth is up about 7%, and their stock is about 94% let already for the new academic year. Last year, they reached a record of 98%. So on the surface, it looks quite favorable. The thing I was interested in this story was whether there isn't a sign or two of a canary chirping in a coal mine somewhere. I was looking, this led on really into a kind of more in-depth investigation into how the university housing market is working in effect. And that relationship between the university's finances and the number of foreign students that they attract these days. So just to give some context, the average British student now pays about 9,250 in fees, which has been frozen since 2017, whereas a foreign student going to the same university might be paying up to 50,000, depending on the university. So the universities have had this massive push towards attracting foreign students because with the fees being frozen and costs rising, their income statements are under a lot of pressure. So one way of getting around that fiscal problem has been to recruit more foreign students. And these students have become an integral part as well of the student housing REITs business plan. The Unite itself lets about 18% of its stock to foreign students. But there are two things that people are worried about. One was the guidelines on visas for postgrads was changed, so they couldn't bring dependents into this country, and that might affect the number of postgraduate students who come, who are as a group are a quite valuable source of income, because they often then stay on in the country doing quite high-powered jobs of various kinds. And the second point really was that the overall number seems to be falling anyway if you look at the statistics, and part of this reason might be problems in China. China's been a big exporter of students, as it were. And there's some data to suggest that Chinese students are not taking the foreign university option as readily as before. Partly this is a cost of living thing. I mean, China's had its economic issues over the last couple of years, but there's also apparently a political dimension to this, that students who wish to advance their careers in certain parts of the government back in China may be penalized if they have a Western education, or at least that's the That's the underlying rumor. So it turned into more of a definite look at this market, and there were some surprising results, I thought, and investors have treated Unite and Empiric particularly as kind of one-way bets, really, that the whole market would grow forever and ever, would keep expanding. But when you start to look at this, the statistics, and the Institute for Fiscal Studies came out with a big study weeks ago, the underlying finances of universities are in such poor state that there is every sign and evidence that the whole business model is broken. So that then leads into a question of whether the whole foundation on which student property is built, not just United Empiric, but the kind of the high multi-occupancy landlord sector, which is a big part of the housing market more generally, whether that isn't facing some considerable pressure.
Yeah, it was interesting, wasn't it? I say interesting, I'm sure other people would have a different word for it, but the overseas student numbers were kind of brought into the political discussion on immigration increasingly in the last couple of years, hence some of these changes and crackdowns, like the dependence changes we saw this year, following on from that big expansion, as you mentioned. From the Unite, the latest figures, they said they haven't seen any impact yet from those January 2024 changes regarding dependence. But there's still, clearly, based on the share price this year, would seem to suggest some uncertainty about those overseas student numbers and how they're going to change. Of course, we have a change of government now as well, but...
Yeah, the NAV has tipped into a discount for the first time. I can't remember the last time it was a discount. Probably after the financial crisis. But it is, when you start to look at the local level, it sort of emphasizes how difficult it is to impose a whole sort of national view on something when there's so much variation between places. So what became obvious when I started looking at it is that certain towns, because of the prestige of the institution, there won't be any problem in the local student housing market. Other towns where the picture is more, they don't attract so many foreign students, that's where you're starting to see student accommodation coming back onto the market, really, and losing, kind of sitting there, perhaps not losing value, but not gaining any either. And it's starting to be, say, first-time buyers who are sort of buying back the student houses in the centre of towns that had been bought up by landlord groups over the last 15 years or so. So there is that trend alongside this as well.
One interesting part might be how we tie together the two conversations we've been having, because the planning reforms could have an impact on the sector, maybe for the better from Unite's point of view, given the way that sometimes these the purpose-built developments are viewed at the moment. Is that fair to say?
Well, it might offer more clarity. The problem that they run into is that, student housing is some of the most objected to planning applications. If you look at the stats, they attract hundreds and hundreds of objections. And in a lot of towns, particularly, it seems like the university, if goes past a particular size, it seems to take over the town. And there's a lot of objections around sustainability issues. If you have a lot of students in certain quarters, it goes dead over the summer, for example. So, our local town here with a large student population is completely empty between May and September on the basis that so much housing has been concentrated in the centre. So that might offer them perhaps more clarity, but I don't know whether it's going to make it any easier. A lot of people say, well, there are still opportunities if you could convert all of this vacant retail space into some sort of living accommodation. You wouldn't need to buy up endless plots of land, and take over old magistrates' courts, or whatever, and knock them down and turn them into student blocks. They could probably adjust it in some way that might benefit the Reits, but the basic fact is that they are, in a sense, they're already at a certain level of capacity. They've got two problems. They're going to have to refurbish their older blocks in the next few years. And if they want to maintain the growth, they have to build new ones as well. So there's a double you can see a series of quite big bills coming in further down the line.
Mm. Unite makes quite a big point, given it's a large part of what they do, really their bread and butter, of contrasting the purpose-built student accommodation, these properties that they build, for which they had that equity raise last year, I think 300 million or so to fund some more building. Contrasting that with the houses and multiple occupation market, which has been struggling, as you mentioned, too. I think that's defined as houses, homes, properties with four to six beds as opposed to 1 to 3 being a family home. But either way, the point being that there's really not much of that kind of property being built at the moment. So that short supply has encouraged and is continuing to encourage students to stay in purpose-built accommodation, not just for their first year, but for second and third years, which Unite says supports its investment case too. It's not a completely apocalyptic scenario if the HMO market is struggling, because Unite says, well, that will simply benefit us. And I think you do mention the piece that, some of these smaller landlords who typically let out HMOs seem to be struggling in particular at the moment.
Oh, well, that's definitely true. I mean, the problem they have is essentially interest rates. That's made the cost of their debt far higher, and also they can't acquire new space easily based on the leverage that they have. I mean, student accommodation, purpose-built accommodation now is quite nice. I mean, when I went to university, and this is literally a true story, the accommodation block was based on the plans of a Swedish prison in Gothenburg.
Yes, we had an interesting fact-checking session on that yesterday, didn't we? But yes, that does appear to be the case, as you say.
And now, it's actually well appointed that they'll probably have some pop art up on the wall somewhere, and that you can see in that scenario that if your alternative is a relatively damp house, overfilled with other people, or a nice new build block that has a decent bathroom attached to the room, that might be an attractive option. And so it's a question of, does the market feel that the purpose of accommodation is going to suffer in a situation where there is still demand from different sections of the student community? And the answer to that is probably not. So, but that doesn't leave the question really answered completely, which is why the share prices are sort of drifting. That's my argument.
Yeah, indeed, especially when they've been priced previously, not quite for perfection, but fairly richly valued. There's more to give, perhaps, on the downside, as we have been seeing in recent weeks and months. We're going to move now, though, to our final segment, our cover story this week. It is our annual Top 50 ETFs, written by Dave Baxter. Dave, I know you've been doing this list now for a number of years, but why don't you talk through, for those who aren't familiar with it, it's in some ways self-explanatory, but talk through how we construct the list and what we're trying to provide in the choice of exchange-traded funds that we highlight for readers.
Sure. So then it's meant to be basically a list of kind of low-cost building blocks or starting points for an investment portfolio. And we look for funds that cover, I suppose, some of the kind of essential areas. So some of the main markets like the S&P 500, but also some more interesting areas that we'll get into. And we tend to look for funds that track the most appropriate markets, that have a fairly robust process, and also those that offer competitive pricing, and those which are kind of large and liquid and therefore have lower trading spreads. And again, that kind of limits your overall cost of investing.
And what about this year? I mean, I think it's fair to say over the years you've honed the list relatively well, and building blocks, passive funds being what they are, there's not going to be a huge amount of change each year. That said, there are a few that go in and out each year. One factor behind this is still price. It was quite interesting to me. I didn't quite realize, I must confess, that the price war, the race to almost 0% fees on ETFs was still continuing to the extent it had been this year, because there have been some changes on the list, and some of them driven by price changes as well.
Yeah, it feels like, we always talk about the price war, and we've talked about that for many years. It felt to me like that had died down. But what we've seen since we last put the list together is a handful of kind of ETF providers, whether that's SPDR or Mundi or others, have started kind of undercutting each other on very mainstream products, so things like MSCI World trackers, S&P 500 trackers, and they're doing that in, going to really sort of rock bottom prices to bring investors in. So in, I suppose, quite a rare occurrence, we've replaced a couple of our kind of US equity and global equity ETFs just because something that is even cheaper has emerged. And then I was just going to touch on, I suppose, some perhaps more interesting changes. So we've consolidated the list slightly. We've kind of removed some funds where there are quite similar offerings, and we've tried to kind of broaden out what's on offer. So we've extended the list slightly into kind of asset classes like property, and also we've looked to cater to areas where people would be quite interested. So one example is we've introduced a India ETF for people who really want to kind of target that one country, given it's been on such a big run recently.
Yeah, I mean, sometimes it can feel too simplistic in various areas of investment to boil things down solely to price. But when you are talking about these core basic trackers tracking the mainstream indices, provided they're tracking the same index and they don't have much tracking error, then really it does just boil down to whether one does charge 0.05% or 0.08, something like that. So price really is the key determinant there. But the list, as you've alluded to, it's split into three categories, isn't it? We've got the core section, which is where you'll find those S&P global trackers in various other countries. And then we have the satellite and the niche sections of the list as well. And that's where, A, you get more esoteric funds, and B, where comparisons come down to more than price because they're all tracking different indices, doing slightly different things as well. Can we talk a little bit about some of those, but also talk about something we do mention as perhaps a caveat to parts of this list, which is the caution maybe investors need to have about thematic ETFs in particular, those focused on particular investment themes?
Yeah, so to firstly touch on the satellite list, as you mentioned, it tries to cater to more specific needs. So for example, you might want some small cap exposure, or you might want funds that deliberately seek out companies that pay out higher dividends. On the dividend front, that's always been a kind of tricky area in the list because we've tended to favor ETFs that are a little bit more cautious when they're seeking dividends. So they might, for example, seek out higher yielding shares, but they look for, they apply a stipulation where companies need to have maintained or increased their dividends for a number of years. By contrast, there are ETFs that simply chase yield, and those have actually performed better because they've ended up including names like some of the big financial stocks, some of the big energy stocks, and they've had some of those kind of cyclical boosts that we've seen in recent years. Turning to thematics, we still include a limited number of thematic ETFs just because they are of interest to investors. They target interesting themes like digitalization or clean energy. But there are some really good reasons to be a bit skeptical and a bit cautious around thematic funds. There are different ways in which they can be problematic. So, for example, if you're targeting a very nascent industry, something like space exploration, there may only actually be a few companies that really capture that theme. So what you end up doing as an ETF provider is you can have a really concentrated portfolio, just a handful of holdings and some big positions. You have a lot of stock-specific risk. Conversely, one problem is some ETFs look to kind of, I suppose, water down their exposure. They look for bigger liquid stocks, or they kind of target the theme in what might seem like quite an indirect way. So, for example, there used to be things like cannabis ETFs that would hold fertilizer companies and that kind of thing. And perhaps investors might not feel like they're getting a pure enough play on the theme. And finally, thematic ETFs can end up basically jumping into a sector when the hype is at its greatest and basically end up buying at the top of the market. And then you can have some really kind of poor returns after that.
Well, leading on from that, perhaps, I mean, there are lots of foibles and different parts of the list, which if you pick up a copy or check it out online, you can see, and we've covered off things like hedged, sterling hedged share classes as well for people concerned about currency exposure, things like that. But I wanted to talk about the disagreements some of the panel who effectively help inform your decisions have had. Because a couple of funds, or one in particular I'm thinking of, and it does come down to concerns perhaps about buying at the top. I'm thinking of the US, I think it's a US equal weighted S&P 500 ETF, which we do include in the list, but which is fair to say has divided opinion. I mean, this is an ETF that is getting a lot of, or at least an index that's getting a lot of interest at the moment because people are concerned about tech shares weighting in the S&P, and they think, oh, well, maybe this is a way to offset that. But it's fair to say not everyone thinks that.
Yeah, so I don't know if you'll forgive me repeating his phrase, but one panelist thought this was a terrible fund.
Yeah.
And basically his argument is that what you're doing is you're kind of missing out on the upside. So because you equal weight all the stocks in the S&P 500, you're not getting those big exposures to names like Nvidia, Microsoft, and so on. So you're not capturing the kind of upswing. And he also worries that you're still going to capture the downside. So if Nvidia suddenly crashes, or those stocks fall out of bed, then perhaps that simply drags the whole market down, and this fund doesn't really offer diversification. But not everyone on the panel agreed, and some believe it can still act as a diversifier. And they also make the case that it's not necessarily having a conventional S&P 500 fund or an equal weight. You can, have a bit of both. You can have a biggish position in the conventional fund and then use the other one to kind of slightly offset some of those concentration risks that you highlight.
Yeah. I mean, I see a lot of things nowadays on what used to be called financial Twitter. I don't know if it still is, if there are enough people on there, but really talking about the discrepancy between the performance of the S&P and an equal weighted version of the index is pretty much never been higher. So clearly there's potential for some mean reversion there, albeit we shouldn't necessarily expect that to happen either, because I think history has also shown that sometimes these big shares can continue to dominate in one form or another for a long time in the future. What about just to wrap up, maybe some of the foibles of the list that maybe I alluded to earlier, looking at things such as the type of share class you buy, accumulation, income shares, things like that, which can trip people up. If people are just starting out on their investment journey in particular, they think I'll buy some ETFs is a pretty sensible thing to do, but you do have to be wary sometimes of things like accumulation versus income shares and which ones are available and what that means at a very basic level for how you're invested.
Yeah, so generally we've picked out accumulation shares because they will simply, reinvest any dividends, and that has that makes a huge difference in terms of the overall returns you can get over the long term. Having said that, you mentioned hedge share classes. Often, if you are looking for a share class that's hedged back to sterling, the only type of share class that will be available is a income or so-called distribution share class. So it is paying out all those dividends to you, but it's not reinvesting them, and that can mean that you kind of lose out on quite a lot of compounding power over the longer run.
Yeah, indeed. And there are certainly, whenever you have a distributing share class in particular and overseas funds as well, the FX charges, the platforms converting those dividends, they can add up as well, albeit the hedging factor complicates that as well slightly. But there's lots more detail in the piece on all these issues. Of course, there's a full rundown on each of the 50 funds and why they've been chosen, and look at some potential alternatives as well. So do pick up a copy of the magazine or look at the article online if this has taken your interest. That, though, brings us to the end of the show. We have unfortunately run out of time. So thank you very much to Dave, to Julian, to Alex, and to our producer, Maddie Apthorpe. We'll see you next time on another Companies and Markets show.